Here's why United Health stock will outperform. First, for those new to the company, we will go through some key background facts. Second, potential investors must understand the challenges faced by the company today. Third, we will explore whether United Health is a possible turnaround play for the patient investor. Beginning with the background, United Health is the largest health insurer in the United States, competing against companies like Elevance Health and Centene Corporation. A simple way to understand its business model is that it collects revenue from customers in the form of premiums. However, it is required to provide medical treatment in exchange if they need it in future. Any remaining monies become profit. As you can see from the first three bullet points, the company's total addressable market virtually includes the entire US population. Under the fourth bullet point, the company also offers insurance to expatriates and travelers from the US when they travel to over 150 countries worldwide. United Health also owns a subsidiary called Optum, which supports its core health insurance business. Optum has three subdivisions as shown on the screen. The first subdivision is Optum Health. Optum Health operates medical facilities such as hospitals and clinics and employs or is affiliated with a large pool of doctors and medical professionals. When customers from United Health require medical services, they can receive it from Optum Health, allowing the company to bypass third-party healthcare providers altogether. The second subdivision is Optum Insight. Optum Insight performs data analytics on United Health's large database to help it to streamline operations and calculate risk. Optum Insight also outsources its services to other independent medical facilities and even competing insurance companies for a fee, and it is a viable business in itself. The third subdivision is Optum Rx. Optum Rx fulfills customers' medication needs. For example, it handles the logistics of delivering medications to patients, and it also negotiates on their behalf with drug manufacturers for lower prices. If you have been keeping up with the news, you may be aware of the large vertical drop in United Health stock price over the past few months. The stock price is currently trading at about $307 at the time of this recording, which values the company at about 278 billion US dollars. Even after the recent recovery, the stock is still down by about 50% from its latest high of around $630 per share in November of 2024. Existing shareholders would have lost most of the capital gains over the past 5 years, and the stock is back at levels last seen in October of 2020. In total, existing shareholders of United Health would have suffered a return of negative 0.46% over the past 5 years. Clearly, they would have been better off from simply investing in the S&P 500 index fund, which returned positive 88.47% over the same period. Here, we can see how United Health stock price has performed relative to its peers in the health insurance industry. For better or for worse, its competitors have also underperformed the S&P 500 index fund in the last 1 year. It is reasonable to infer that the health insurance industry as a whole is facing headwinds. In the next section, I will explain some of these headwinds and how United Health has been affected in particular. So why did United Health, one of the largest blue chip companies in the United States, lose hundreds of billions of dollars of its market capitalization in less than a year? In this video, I will be covering 3 reasons, which are shown on the screen. Number 1, the company is under scrutiny by regulators. United Health announced in July of 2025 that it is currently complying with criminal investigations by the US Department of Justice over its billing practices in its Medicare Advantage segment. Specifically, there were allegations that it had excessively inflated patient diagnoses in order to receive higher payouts from the government program. There are also allegations that the company had urged vulnerable patients to sign do not resuscitate orders in order to keep their costs down. Separately, the company is also facing an antitrust probe. As mentioned earlier, United Health operates medical facilities through its Optum Health division, which vertically integrates with its health insurance business. Regulators are currently looking into whether United Health has been unfairly directing its customers towards facilities that are operated by Optum Health and refusing to cover services offered by unaffiliated facilities. If true, this could constitute unfair competition and harm customers by preventing them from choosing the best or the cheapest healthcare provider available. So far, these 2 investigations are still ongoing, causing negative sentiment around the company. Lastly, the Department of Justice had also objected to Optum Health's acquisition of a company called Amedisys. Amedisys is in the business of providing home and hospice care to patients, with over 500 locations across 37 states. The Department of Justice was concerned that this acquisition would eliminate competition for such healthcare services in certain areas, given Optum Health's large existing network of healthcare facilities. In the end, a settlement was reached. The acquisition was was allowed to go ahead, but Optum Health was required to divest at least 164 of its existing facilities in other areas and pay a small fine. The second challenge facing United Health today is its large earnings decline in the most recent second quarter of 2025. The company saw its earnings per share come in at only $4.08, which was a 43% decline from the previous quarter. To make matters worse, management has also been inconsistent in its projections for full year 2025 earnings. A timeline of events is shown on the screen. Late in 2024, management initially projected for full year earnings for 2025 to come in at between $25.50 and $30. However, on 17th of April 2025, this was abruptly decreased to between $26 and $26.50. About a month later, management then withdrew this guidance completely, while the United Health Group CEO stepped down for quote-unquote personal reasons. 2 months later, the company came out with a revised projection of quote-unquote at least $16. However, this was a far cry from the initial projection, representing an almost 45% decrease. This created extreme fear and caused the stock to log its recent low of about $237 per share. Ultimately, investors seek certainty, and the company has not been delivering it given this recent spate of adjustments. Taking a deeper dive, the reason why United Health has seen its earnings decline is because there has been a rise in medical treatments among its customers. During the pandemic, many customers who needed elective surgical procedures opted to delay them because of staffing shortages and the risk of infection. Examples of elective surgical procedures include hip and knee replacements, which tend to be relatively less urgent. Now that the situation has normalized, many customers have started resuming these procedures. However, the backlog turned out to be larger than expected, which caused United Health to incur excessive costs that reflected in its lower earnings in the recent coming quarters. To compound the situation, inflation has also been rising in the medical services sector. According to the US Bureau of Labor Statistics, the US medical care CPI has increased by almost 17% in the last 5 years. This has created a situation where United Health has to not only pay for a larger quantity of treatment, but also pay more for each unit. So far, we have been exploring these two recent phenomena from a layperson's perspective. However, we can also analyze their impacts through a financial perspective. To do so, it is necessary to introduce the medical loss ratio, or MLR for short. The MLR quantifies the amount of money that United Health had to pay out to its customers for every dollar of premium revenue that it received. The MLR is inversely correlated to earnings. From the table shown, United Health's MLR has steadily increased from a healthy 82.8% in 2022 to a projected 89.25% in 2025. This is good news for customers because it means that more of their premium revenue is returning to them as medical services. However, it is bad news for United Health because it means that their actuaries had failed to price the previous year's premiums high enough to allow for a sufficient profit margin. This explains why the company saw a sharp drop in adjusted earnings per share in the recent second quarter of 2025, despite record revenue. While United Health is not the only health insurance company that has had to deal with an increase to its medical loss ratio, it is the only health insurance company that has also had to deal with a ransomware attack on its subsidiary during the same period. As a result of this, United Health suffered revenue loss from disrupted operations and also had to pay the hackers a $22 million ransom to prevent disclosure of the stolen data. Furthermore, it also had to extend financial assistance to affected healthcare facilities in the meantime because the payment disruptions caused cash flow issues. In total, the attack is estimated to have cost United Health over $3 billion, which contributed to the steep drop in earnings in the previous quarter. There is also a third reason why investors are pessimistic over United Health's prospects in the medium to long term. On the 4th of July 2025, US President Donald Trump passed the Big Beautiful Bill Act, which is projected to cut Medicaid funding by approximately $1 trillion over the next decade. This means that health insurers will potentially start to see disenrollments from their Medicaid segment from next year onwards, because many of these Medicaid recipients come from lower income backgrounds and they are otherwise unable to afford health insurance premiums out of their own pockets. That being said, it is also important to note that United Health's Medicaid segment currently only contributes to about 20% of its revenue and 13% of its operating profits. This means that besides constituting only a fraction of the company's overall business, it also generates relatively lower margins. This is because Medicaid plans are funded by the state at capitated rates with very low profit margins built in, and policyholders also tend to empirically have higher health needs, which drives up utilization rates under these plans. Therefore, United Health will be relatively less affected by these Medicaid funding reductions as opposed to competitors like Centene Corporation and Molina Healthcare, because these companies derive more of their revenue from Medicaid funded plans. Now that we have explored the challenges facing United Health, is it still a good investment at current prices? In my opinion, the answer is yes, because of these 5 reasons. The next section will explore each in detail. First, if you recall, United Health is suffering from declining net profit margins due to a high medical loss ratio. However, this is a problem that can be easily addressed by raising premiums. In fact, many health insurers in the US have already signaled that they are going to do so next year. Based on preliminary data, most insurers will be increasing their premiums by about 10 to 20%, which is more than sufficient to offset the high medical loss ratio. At this point, you may be wondering whether these price increases are actually feasible, since the health insurance industry is highly regulated. If you did, you are right to think this way. Health insurance premium prices are indeed subject to regulation in the US. However, the good news for United Health is that its proposed price increases are likely to fall well within this limit. Under the Affordable Care Act, health insurers only have to ensure that their medical loss ratio stays above 85% for large group plans, which are those plans that consist of more than 51 members, and 80% for individual and small group plans. Otherwise, the insurer is required to issue a rebate to their policyholders. From this table, United Health had previously attained a medical loss ratio of 82.8% in 2022, which is optimal because this maximizes its profit margins while still leaving some buffer room to comply with the statutory requirement. Given that its current medical loss ratio is sitting at 89.25%, there is clearly significant room for it to raise premiums back to a more sustainable level while still abiding by these regulations. If United Health executes this successfully, it will quickly see a corresponding increase in its adjusted earnings per share within the next few quarters. Now, we will be looking at United Health's earnings track record over the past 10 years. For the entirety of 2025, if you recall, the company recently projected quote-unquote at least $16 per share. Notwithstanding the meaning of the first two words, analysts have generally adopted the lower end of this range and expect EPS to come in at $16 flat for the entire year. Nevertheless, even if we do adopt this consensus and visualize it on this chart, it is clear that United Health would technically have already returned to earnings growth in 2025, signaling that the worst is already over. For reference, before 2024, United Health grew its earnings per share at about 19% every year. If it can return to this rate of earnings growth, then it will only be a matter of time before the company achieves record earnings once again. Now, given that management had technically signaled that earnings for 2025 would be quote unquote at least $16, it is reasonable to speculate whether the number will come in at much higher than the bottom end of this range. To get a better sense, we can see here that United Health has already reported a total of $11.28 in adjusted earnings per share during the first 2 quarters of 2025. In other words, to meet the baseline expectation of $16 per share, the company only needs to earn $2.36 in each of the 2 remaining quarters. In my opinion, this is an unrealistically low target, and United Health is likely to exceed this baseline expectation by the end of 2025. Let me illustrate why. This is a single stack bar chart that visualizes the magnitude of the baseline earnings expectation relative to the previous 2 quarters. As you can probably see, barring any further bad news, it is highly unlikely that the company will only earn $2.36 in both of the 2 coming quarters. After all, if United Health managed to earn $4.08 in the most recent second quarter of 2025, despite all of the challenges that it is already facing and a major ransomware attack, then there is no reason why it cannot do the same in the next 2 quarters. In my opinion, adjusted earnings per share for the full year of 2025 is more likely to come in at around $19 per share, which greatly exceeds the baseline expectation of $16 per share. This is a very likely scenario that is not yet priced into the stock. By the time it happens, United Health stock may no longer present the great buying opportunity that it does today. Earlier, it was mentioned that United Health is likely to raise premiums in the coming year so as to reduce its medical loss ratio back to a more sustainable level. However, you may be wondering whether this would cause the company to lose market share. Fortunately for United Health, this is not a major concern because it has a wide economic moat. Having a wide economic moat is essential under the value investing approach because this This grants a company pricing power over its customers and the ability to fend off competitors, which ultimately allows it to earn above average returns on capital over the long run. United Health has four components to its economic moat. This subsection will explore each in detail. The first component of United Health's moat is its sheer size. Despite the earnings decrease in the most recent second quarter of 2025, the company still saw record revenue of $101.6 billion US dollars. To illustrate, United Health collected more revenue during this period than the economic output of entire countries like Singapore and Hong Kong. In fact, the company insures almost 1 in every 7 people in the United States. This large size gives United Health immense leverage in its operations. The company is able to negotiate for lower rates with independent healthcare providers and drug makers on behalf of its patients, which minimizes costs. Fixed costs can also be spread over more patients. This has allowed the company to invest heavily in its Optum Analytics network, which has reaped dividends over the past few years. Currently, the company has also moved ahead with the integration of AI into its systems, ahead of its smaller competitors. The second component of United Health's economic moat is its deep vertical integration. With the establishment of its Optum subsidiary in 2011, United Health is no longer just a health insurance company. Optum Health, for instance, currently operates the largest network of healthcare facilities in the United States, which either directly employs or is affiliated with 8% of all of its doctors. As mentioned earlier, it is also acquiring Amedisys, together with its over 500 home and hospice care facilities. This extensive network allows United Health to provide medical services to its customers in-house without having to go through middlemen. Crucially, United Health's vertical integration also allows the company to provide value-based care. Let me explain what that means. Under the traditional insurance model, the insurance company would refer its customers to independent healthcare providers such as a hospital and pay the hospital based on the quantity of healthcare services provided. However, this was problematic because hospitals tended to deliver excessive medical treatment since it was in their best interest to do so under this model. This led to significantly higher costs paid by the insurance company and was also not in the best interests of the customer. In contrast, under United Health's vertically integrated model, this problem is avoided completely because it now owns the hospitals directly under its Optum Health division. This means that the hospital's financial incentives are now aligned with United Health's, which naturally drives the hospital to focus on improving patient outcomes rather than subjecting patients to as many procedures as possible under the traditional model. This reduces costs for United Health and is also good news for its customers. Optum Insight, on the other hand, uses data analytics to leverage United Health's extensive database and streamline operations. For example, it can identify patients who are at risk of contracting more serious diseases in the future based on their medical history. This early intervention helps United Health to avoid having to pay for more costly treatments later on. In fact, Optum Insight's analytics tools are so essential that they are used in 80% of all health plans in the United States, which means that even United Health's competitors have to rely on it. In the process, United Health can collect additional revenue from these competitors while also potentially gaining an informational edge into their operations. Finally, Optum Rx serves the pharmaceutical needs of United Health's customers. For instance, it allows United Health to develop its own drug formularies for its plans in favor of cheaper generic drugs, which helps the company to avoid paying astronomically high prices for certain labels. Optum Rx also leverages United Health's massive customer base to negotiate for lower costs from drug manufacturers, which is an advantage that smaller competitors like Centene do not have. Ultimately, United Health's Optum subsidiary makes it arguably the most vertically integrated health insurer in the United States. Customers also benefit from this vertical integration as it allows them to settle most transactions through the United Health app without having to deal with multiple entities and fragmented medical records. A third component of United Health's economic moat is the high costs of switching away from its ecosystem. For healthcare providers that are already affiliated with United Health, such as a hospital, it is difficult to switch to provide the services to patients from another insurer instead, because this will mean losing access to Optum Insight's analytics tools that are critical for streamlining operations. Moreover, given that United Health is the largest health insurer in the United States, with the largest existing customer base, this creates a strong incentive to remain in its network. If the hospital does switch providers, it will also have to migrate massive amounts of existing customer data to the new provider and retrain its staff on a new platform, which is not only costly, but also risks data loss. Similarly, for policyholders, switching insurance providers would require them to undergo the lengthy underwriting process all over again. For customers who are already receiving treatment, they risk losing treatment coverage or losing their existing medical records if their current hospital has an exclusive arrangement with Optum. In fact, in some cases, it may not even be possible to exit from United Health's ecosystem entirely, given its extensive integration into the healthcare network. Lastly, existing policyholders also have to abide by contractual lock-in periods and specific enrollment windows. Ultimately, this means that it may not be worth the hassle for existing policyholders of United Health to switch to another insurance company, even if doing so means saving a few $100s annually. Finally, the health insurance industry is also protected by regulatory barriers to entry. For instance, an aspiring entrant will need to obtain separate licenses to operate in each state, and each state has its own set of different qualifying requirements. They will also have to demonstrate a robust financial position and a sound business plan from the get-go, which is no easy feat. Of course, existing competitors could also challenge United Health's dominance in the healthcare provider network through acquisitions. However, as evident from the amount of regulatory scrutiny that United Health itself attracted during its recent acquisitions of Change Healthcare and Amedisys, this is not a straightforward route either. Although smaller entrants may receive more lenient oversight, acquisitions remain an inorganic and costly manner of expansion that often requires the taking on of excessive debt and unforeseen risks. Seen this way, regulatory scrutiny actually benefits United Health as the currently entrenched player. It must also be mentioned that the Health Insurance Portability and Accountability Act, or HIPAA for short, and other data privacy laws impose stringent data privacy obligations upon companies in the health insurance industry. Companies are required to undertake extensive and often costly cybersecurity safeguards, and breaches can attract severe financial and reputational penalties. In fact, the latest ransomware attack that happened to United Health is a case in point. Fortunately, the company was large enough to absorb the $3 billion in financial impact, but the same may not be said for a smaller company. Ultimately, the health insurance industry is notoriously difficult for new entrants to break into and sustain, which favors larger and more experienced players like United Health. United Health's economic moat is reflected in its financials. From this chart, we can see that the company consistently manages to achieve a higher return on equity as compared to its competitors. This means that it can convert shareholder equity into profits more effectively. It is not that competitors are not trying hard enough or do not want to achieve a higher return on equity, but because they simply cannot compete on the same playing field as United Health given its economic moat. The net profit margins tell a similar story. Before the one-off $3 billion hit suffered by United Health from the ransomware attack in 2024, the company had consistently achieved a higher net profit margin than its competitors, which means that it kept more of every dollar of revenue as profit. Once again, this reflects the structurally lower operating expenses that United Health enjoys due to factors such as its large in-house network of doctors and healthcare facilities under the Optum Health division, and also its streamlined operations gained through Optum Insight. In summary, United Health's durable economic moat has and will continue to translate into superior financial performance against its peers. Next, it is also necessary to address the investigations that are currently being conducted by the Department of Justice against the company. At this point, it is difficult to predict how the court will rule on this. Nevertheless, I wish to offer an alternative perspective. This may be counterintuitive, but a negative outcome in the investigations for the company can actually be positive for United Health investors. Once again, a negative outcome in the investigations for the company can actually be positive for United Health investors. As investors, we should only be concerned about the financial perspective of United Health into the future. This means that as long as the company is able to maintain its competitive advantage, everything else is irrelevant in the long run. Therefore, the ruling is unlikely to impact the investment thesis for United Health because it is unlikely to erode the company's competitive advantage. More on this later. For further context, many of the most well-known and high-quality businesses today, such as Microsoft, Meta, and Alphabet, have also been subject to regulatory scrutiny in the past. They have been ordered to pay financial penalties or change their business practices, but this did not stop them from continuing to deliver superior returns to the investors after a few years. Similarly, the eventual rulings may represent the light at the end of the tunnel for United Health because it will clear up the uncertainty that investors are currently facing over what lies ahead for the company. As earlier mentioned, the ruling is unlikely to erode United Health's competitive advantage over the long term. There are three reasons why. First, the company has already taken accountability and effected leadership changes at the highest executive level. In the past year, United Health has seen a new CEO and CFO at the group level and new CEOs for its its insurance and Optum businesses. This massive leadership transition demonstrates the company's commitment to voluntarily reviewing and improving its practices. If the court rules against United Health, the company can immediately hit the ground running and begin repairing any reputational damage. Second, the probes by the Department of Justice only relate to specific practices within United Health's business segments, such as how it bills for Medicare, how it compensates doctors within its provider network, and its acquisition activities. Therefore, penalties are likely to be limited to requiring United Health to correct these practices. It would not be within the scope of the investigation for the court to order a breakup of United Health's vertically integrated business model, because this is an exceptional remedy that is reserved for cases where a company has been engaging in a pattern of clear monopolistic conduct that cannot be resolved through less drastic measures. This is not the case here, because the US health insurance industry is an oligopoly and not a monopoly. Such breakups have also been rare in history. For example, an attempted breakup of Microsoft in the 2000s ended in failure. It is also worth reiterating the benefits of United Health's vertical integration to the end consumer, which further weakens the case for a breakup. Third, United Health has faced a similar probe by the Department of Justice into its Medicare Advantage practices in the past. It had previously been under investigations and proceedings for over 10 years, but ultimately the Department of Justice was still unable to make its case, resulting in a court ruling in favor of United Health in March of 2025. This recent case will likely serve as a legal precedent in favor of United Health's Medicaid practices in the current proceedings. It also illustrates the significant evidential burden that the Department of Justice is up against. Next, let's understand more about who is now leading the United Health Group. In May of 2025, Stephen Hemsley replaced the outgoing group CEO, Andrew Whitty. However, from this official press release, Hemsley is actually not a newcomer to the company. In fact, this will mark his second stint as Group CEO after having served a first stint between 2007 and 2017. Prior to this, he had held other executive positions within the company since joining in 1997. During Hemsley's first 10-year stint as Group CEO, the company had performed well. During this period, it went through the 2008 financial crisis and also saw the creation of its Optum divisions, which, as we have just seen, turned out to be a very strategic move. United Health's share price increased by 400% during this period. Furthermore, note that Hemsley had personally acquired about $25 million worth of shares in the company a few days after the announcement of his reappointment as Group CEO. The company's CFO, John Rex, also acquired about $5 million worth of shares. This is significant because, as put by the legendary fund manager Peter Lynch himself, insiders might sell the shares for any number of reasons, but they buy it for only one, namely because they think that the price will rise in future. Here, these two votes of confidence are coming from the two people who arguably have the clearest overview of the actual state of the company from the inside. Of course, some may point to the timing of these purchases and dismiss them as nothing more than a calculated move to improve investor sentiment of the company. However, note that the amounts involved represent over 7% of the net worth of each of these individuals in both cases. In my opinion, they are putting genuine skin in the game because they believe in the prospects of the company. The company has also been aggressively repurchasing its own shares. It returned almost $5.5 billion to shareholders through these share repurchases in the first half of 2025, and it is still authorized to repurchase a further $6.5 billion in future based on current prices. In my opinion, this is a good way to increase shareholder value in the long term because the current undervalue means that the company will be able to buy back more shares for the same amount of money. Moving on to valuation. From this chart, we can see that the company's price to operating income ratio is currently near a 5-year low. Does this represent a deep value buying opportunity, or are investors attempting to catch a falling knife? In my opinion, United Health stock currently represents a deep value buying opportunity because the present share price is far below its intrinsic value. From this chart, United Health has increased its free cash flow at an average rate of 12.17% per year over the past 10 years. However, let us adopt a margin of safety and conservatively estimate that free cash flow will only continue to grow at 6% per year over the next 10 years and 2.5% perpetually thereafter, which is in line with inflation. Based on these assumptions, the present value of United Health's discounted future cash flows is about $453 per share today. At the current share price of $307 at the time of this recording, the company is trading at a 32% undervalue. Investing into United Health today essentially guarantees a hedge against inflation because the company is paying an annual dividend of 2.77%, which exceeds the US Federal Reserve's long-term inflation target of 2 to 2.5%. In addition, the company has a strong record of consistently increasing its dividends over the past 16 consecutive years. Its dividend payout ratio is 37%, which means that 37 cents out of every dollar of net profit are paid out as dividends, which is a sustainable figure. From the chart on the bottom right, the growth rate of free cash flow has also outpaced the growth rate of its dividends over the years, which is another indicator of a sustainable dividend. Therefore, investors can be assured that the company can maintain and even increase its dividend in the years to come. Even if the stock price remains at current levels for a prolonged period, investors will be paid to wait. From a broader perspective, the healthcare sector is generally a good industry to be invested in over the long term. The most obvious reason is because the US, just like most other developed economies, will start to see an aging population over the next few decades. This will increase demand for United Health services as older people are naturally more in need of protection against and treatment for chronic illnesses. The company is well poised to ride this secular tailwind. In fact, from this chart, we can see that United Health has consistently increased its revenue per share by an average of 12.37% every year over the past 10 years, despite the recent headwinds. Another reason is because healthcare also tends to be defensive and counter-cyclical in nature, which means that its companies are more resilient to economic shocks. Healthcare and insurance services are a necessity that people need to continue paying for even during a recession. In today's euphoric market climate, where technology and AI companies are trading at record valuations following strong earnings and impending interest rate cuts, it might be tempting to throw caution to the wind. However, as put by the legendary investor Warren Buffett, it pays to be fearful when others are greedy and to be greedy when others are fearful. In my opinion, for investors who are already highly long on the aforementioned sectors, it is important to be prepared for when the momentum slows and sectoral mean reversion occurs. For such investors, United Health stock will not only offer superior returns at this point, but also diversification and a spreading of risk. Before concluding this analysis, I have one final perspective to share. As you may already know, Warren Buffett recently announced a $1.6 billion US stake in United Health through Berkshire Hathaway. This is encouraging given that he has achieved a remarkable track record of 19.9 compounded returns on average every year since 1965. He has achieved this through his value investing strategy of buying wonderful companies at fair prices. What makes Berkshire's recent acquisition of United Health stand out even more is that this is Berkshire's first major purchase of such a scale since October of 2022. Before this, Berkshire had been a net seller of stocks over the past 11 consecutive quarters. A further piece of information is that one of the most recent companies that Buffett had acquired through Berkshire before United Health was Occidental Petroleum in 2022. That stock turned out to be the best performing stock in the S&P 500 that year, delivering a total return of 119%. Besides Buffett's Berkshire, investor Michael Burry also announced a stake of 20,000 shares and 350,000 shares through long call options in United Health through his fund, Scion Asset Management. Burry is famous for having correctly predicted and making a fortune from shorting the 2008 subprime mortgage crisis. He also successfully managed to hedge his portfolio in the first quarter of this year, before the Liberation Day stock market crash in April. Both Warren Buffett and Michael Burry are influential investors, albeit with fundamentally different approaches. However, the point here is that both have taken long positions in United Health in a rare show of consensus. Therefore, regardless of whether you are a proponent of pricing the market or timing the market, United Health would satisfy the investment criteria. Personally, I am a fan of the former approach, and I believe that the investment thesis for United Health is a compelling one that will deliver outsized returns for the patient investor. Thank you for watching until the end, and I'll see you in the next video.